The yield curve is inverted but headed towards positive. If the Fed doesn't lower rates next year, then it's possible for longer term rates to still go higher by a few percentage points. If this happens, then do you think the market will officially bottom then, or do you not care about this at all?
Oh, we definitely care about it. And you're right. The yield curve, which was extremely inverted at the beginning of this year, is approaching flat and may even revert back to a typical upward, from left to right, upward curve. However, there's a phrase in the financial markets called beware the steepener. It's actually a really dangerous sign when the yield curve goes from extremely inverted and reverts back up to an upward moving curve. And essentially, when that actually happens is almost always when a recession actually hits. So the inverted yield curve, meaning longer term rates are lower than short term rates, is a predictor of recession. When the curve gets back to flat or up, that's typically when the recession actually hits. So that is something we are watching. In terms of longer term rates, what is the effect of that? Most commercial mortgages are based on, not most, but many commercial mortgages such as Fannie Mae and Freddie Mac are based on the 10-year treasury rate. And if that continues higher, today it's like 4.9 something. If that continues higher, then that will continue to put additional pressure on commercial real estate. So yeah, that is something we're watching. My guess is without some external event, I think the highest probability outcome is that the 10-year tops out around 5.25, and that would probably be the cycle high. There is a reasonable possibility that if it breaks, that it gets closer to 7. But with a recession probably coming, my guess is the 10-year tops out somewhere at 5.25. Again, that's not a prediction. That's what I see as the highest probability outcome. And yeah, it's absolutely something we're watching.